Well, hello, traders and investors. I'm LA Little, and this is your daily NeoTA wrap, where we take a look at these markets and we do it from a neoclassical perspective. This is the model created about a decade ago. Have used it in up and down markets, have made money both ways. It's a good model in that it tells you which way trend is in a very dynamic way, and tells you where supply and demand is on the charts. And that's in essence what the model is about. That's what I use exclusively and invite you to use if you so choose. And if you're interested in that, you can write me and I'll give you more information and talk to you about it. As far as these markets and what they did, here's the ending numbers. You did have a sideways day, again, another flat day, down slightly on the S&P. We actually had a, actually these numbers don't look right. This looks old. 1, 2, 3. It does look old. The S&P was slightly up today. You had big gains in Europe today. These numbers are not right, so we'll take that off the screen. You had a small gain, but pretty much flat across the board here on the domestic indexes. Big rally over in Europe. One of the things I was looking at and curious about myself, and I know this looks like Greek, but I was just pulling some numbers here before I came on air. I was curious as to what the numbers look like since earnings began to come out. So I just looked simply to say, you know, what's the count of those active stocks, get rid of ETFs, all those things that have gained. And I didn't try to link it to earnings. I just simply said across the board, how many of them have gained, how many have lost. So it's about 16 to 11 roughly in terms of gains and losses. And then I looked at the average close and the average loss on a close of those two, about 3.8, 1.7. So you can see that on average, the gains have been better than the losses in terms of price since earnings began. I'll do this again by the end of the earnings season, but the majority of it is in, or a vast majority of it is in. And so, you know, actually earnings season hasn't been that bad when you look at it from that perspective. Let's take a look at the charts here to see what they look like. And essentially what we're going to see is what we saw yesterday, and that is that they try to press them down, right? So they go into, this is the key bar. So they go into that bar. They can't hold it into the bar. They've tried 2 days in a row now. They did press down with more volume today, but by the end of the day, you're right back up there. You're holding this tight little range. Swing point high is up here, and essentially you're playing this range right now. You get down here and you hold, or you get up here and you hold, then you can get another leg one way or the other, and that's really where the supply and demand will crack, all right, one side or the other. You had a pullback on the NASDAQ, but again, a pullback and it holds. If you look at the NDX, it's the same thing, right? And well, we're getting some weird supply numbers in here, but same sort of thing, right? No real difference. They look the same. Finally, if we come over to the Russell. Now, the Russell had came in to do a bullish retest, regenerate. Question is will it regenerate to the top side? And that area is here. It's also on this big, and that low is there. And so as you can see, it's doing a full retest, and an attempt to regenerate is what you would expect. But you know, full retest off this swing point high is what the model would call for. So far, all of this is in order. Question is this going to regenerate? In other words, is it going to push back in the direction of the break? This is your break. Or is it going to fail? If it fails, it says what was this way no longer is. It's probably that way for now on this time frame. And that's what the model tells you, right? Tells you to expect. If you don't see what you expect, then something else is happening, because most of the time you'll see the market actually do what you would expect it to do. And that's what it should do, since that is what the model is based on. And so from right now, from this perspective, everything suggests that what has been happening is going to continue to try and happen, and that is that these markets are going to try and push higher. If we looked at the world markets, you'd see nothing but a lot of green. Today, they continue to push to the top side. Here's the German market. If you look at the French market, of course, the French market getting big gains as well. You see it in Switzerland also. The election coming up this Sunday, and the election at this point is a foregone conclusion. The market expects that Le Pen will lose and that you're going to get stability in Europe, and therefore you're going to see these markets continue to put risk on, and that's what they're doing right now. If we look at the OX markets, that's where you're seeing the opposite effect, and that is if you look at, for example, volatility is falling through the floor. If you look at the silver markets, if you look at the copper market, look at that decline. Look at the copper market. Look at your gold market. Look at your gold stocks, right? Look at the commodity index itself, right? All of these are getting slammed lower and lower. They all are being pushed to the downside. Everything that's being pushed to the upside is equities. Outside of that, you're not seeing it. Is there anything else important here? Probably not. Of course, if you're doing anything with Europe, you're seeing big gains. Here's the European financial shares. Those guys have been on a tear, and they continue to benefit from the election expectations and what's happening in Europe. If we go over to currency markets, you're going to see the dollar under pressure, and that's because you're thinking, or the markets are thinking, you're going to get stability in Europe, and as that dollar comes down, it's testing to the downside here, trying to break again. If we look at it on the weekly basis, it's already broken a swing point low. It did that last week. Now it's trying to come into this swing point high, 25.23. If you flip over to the other side of this, which is the euro is pressing up, making new highs today, breaks out on the daily, coming up to get to the swing point low in the breakdown bar. And if you draw those in, this is where you would expect it to try to get. It's going to be first time back after more than 6 bars, after way more than 6 bars. I expect what you should see, or the model would suggest, is that what you should see here is you should see this thing reverse and try to come back down. And so if you're betting against the dollar at this late stage, it's probably not the best bet, or if you're betting with the euro, it's probably not the best bet either. Yeah, you can get the last push here, but if you do your ABCD structures, they say you're going to get a turn there, or at least you're going to play out on that move, and as you come into this, the model says you should get a push back the other way. Euro going up, yet European markets going up as well. We haven't seen that probably in 4 years by my count. So another thing that has changed, at least on a short-term basis. What's tomorrow going to bring? You got employment numbers. You got 5 or 6 Fed speakers. My take, and I had mentioned this on Twitter, is that it doesn't matter what happened with the Fed on Wednesday. What's really going to happen is when the Fed speaks on Friday, because the Fed on Wednesday was simply a statement, no press conference. So the Fed speakers tomorrow are going to be the main thing. Let's see what they say. Right now, if you're looking at the equity markets, there's still nothing out here to tell you that you've got to turn. And so you have to lean to the long side. If you're going to err, you err to the long side. How much you're long is a question of risk that you want to take. Stretch market, stretched MTTFs, they continue to stretch. Have a great one. See you later. Good night.